Dean Zayed, your smart option strategy has traditionally outperformed the S&P significantly. It's trailing a little bit this year. Tell me why.
It's a hedged equity strategy, Greg. So essentially we're trying to get most of the upside of the market, but always have a protective put in there to cover the downside. So in straight up years like this year, it's supposed to lag a little bit. The key is to avoid large losses in the big bear market years.
So for investors who are concerned with, for example, a big sell-off because of the fiscal cliff or Europe breaking up, yours would be a strategy they might want to check out, right?
Without a doubt. Again, it's all about the math. If you don't compound a minus 37 like those did in 2008, you're going to be way ahead if you can limit those losses to 3 or 4%.
Now, you don't sell calls or sell puts against individual stocks. You mainly traffic in the SPY. So why don't you explain a little bit about the mechanics of your smart option strategy?
Great question. Mechanically, we're long the SPY, which is the S&P 500, with about 85 to 90% of a client's portfolio. We're going to take the other 10% and buy a long-term protective put that covers the downside. We're going to enhance the returns and help pay for that put by having a monthly trading strategy in which we sell calls and puts on the SPY.
And right now you've seen the VIX trade at pretty low levels. It's around 16. Could pop up at any moment considering all that's going on in the world. How does this affect your strategy?
Well, because we're buying a long-term put as well as selling on the short-term end with calls and puts, it really goes both ways. So it could make a put cheaper, but it's going to then also make your short-term play cheaper as well.
And do you expect this mild volatility or this low VIX to continue throughout the end of this year as well as 2013 with all the things that are going on in the world?
We actually expect some choppiness here throughout with obviously a lot of headwinds coming up. We say choppiness at best with some heightened levels of volatility we expect.
And is this the kind of thing that investors can do at home to put collars around indexes like you're doing? Because a lot of people are getting more familiar with options, or do you think it's best left in the hands of professionals like yourself?
Well, in this case, I'd say let the professionals do it because it's pretty sophisticated and you've got to really stay on top of it on a daily basis because if we hit certain levels, we're going to make a trade on those options on a daily basis potentially.
And will this strategy work in other asset classes like gold or I'm not sure what else you can use a collar strategy on, but will it work outside the SPYs?
It works outside the SPYs with very heavily traded indices, like the NASDAQ or some of the sector plays in the S&P, which we're exploring the use of using some other ETFs with the same methodology.